Good morning, students. Welcome back to the session on Ind AS. So today we are going to continue with our discussion on financial instruments. All right. Yeah. In the last session and in all of these sessions on the financial instruments, we have been discussing various topics under this chapter, which largely covers the requirements of Ind AS 109 and Ind AS 32. If we just start from the beginning, we were discussing about financial assets, financial liabilities, and the equity. And then we also moved on to understand their classification and measurement requirements. And in the last couple of sessions, we have focused on liability as well as equity, wherein we understood in what situation an instrument can become a liability or an equity, and accordingly, how this will be accounted for. Yeah. So all through our focus has been on these three types of instruments, or you can say instruments in terms of their classification and measurement by checking whether they will become a financial asset or a liability from the issuer's perspective as well as from the holder's perspective. Yeah. So now we need to just go back to our discussion of classification of the financial assets and the classification of the financial liabilities. If you remember, we discussed that this classification of financial assets is based on the business model of the entity. But the classification of financial liability had some other criteria, wherein only two buckets were available. So we said that a couple of instruments, for example, contingent consideration in a business combination, or if there are any liabilities which are held for trading, those will get into this bucket of fair value through P&L in case of financial liabilities. Otherwise, the remaining liabilities which are financial will go to amortized cost bucket. Yeah. And therein, then we moved on to debt versus equity to understand financial liabilities as well as equity into more detail. Correct? Yeah. So now I'm taking you back to that classification. All right. Yeah. So you just need to sort of remind and come back to that classification discussion. And we are now moving further with that. Now, in terms of this classification for financial liability, if the classification is done, that becomes irrevocable. That means if a financial liability is bucketed into fair value through P&L, so that will continue to remain under fair value through P&L. If a financial liability is bucketed under amortized cost, it will continue to remain under amortized cost. So it doesn't change. Yeah. So this bucket doesn't change. It remains over there forever. But this is not the case for financial assets. For financial assets, it's possible that some of the financial assets which may be bucketed under amortized cost may now be required to be reclassified to fair value through P&L or fair value through OCI. And why would that happen? As we discussed earlier, that would happen when there's a change in the business model. Because classification in case of financial asset is all dependent on the business model of the entity. So if the business model changes, the classification also changes accordingly. Correct? But let's try to analyze this point practically. Though we are saying that the classification of financial asset will change, but let's understand that can we see the business model of an entity getting changed on a frequent basis? Or do you really see changes in the business model of an entity every now and then? No, it's not possible. It is rare. It is rare that an entity will change its business model, because otherwise the entity is not really working in a manner that it is able to achieve its objectives. Because what's the objective? Objective of any organization is to grow, expand. So if that objective has to be met, that is possible when the organization will always be focusing on the business model with which they would have started. Correct? But if they want to discontinue that business model, that means somewhere the objective of the entity is not getting achieved. Yeah. So even though we are now going to discuss about the situation of reclassification, which will occur whenever there will be a change in the business model. We are saying that these type of situations will be rare. Correct? Yeah. So now, if we come back to our discussion of reclassification, I would just request all of you to get onto this module section number 3.9 and page number 12.91. Okay. Section number 3.9, page number 12.91, wherein the reclassification has been discussed. So we'll pick up various examples to discuss about all of these reclassification requirements. All right? Yeah. So if we look at a couple of examples which are given, it says example of a change in business model include the following. An entity has a portfolio of commercial loans. I'm sure that you are now referring to the study material, please. Yeah, it's important for your understanding. An entity has a portfolio of commercial loans that it holds to sell in the short term. So it is holding to sell. The entity acquires a company that manages commercial loans and has a business model that holds the loans in order to collect contractual cash flows. So now entity has acquired another company, and this another company has a business model of hold to collect instead of selling. The portfolio of commercial loans after the acquisition of this company is no longer for sale, and the portfolio is now managed together with acquired commercial loans, and all are held to collect the contractual cash flows. So in this case, what has happened? In this case, entity was initially selling the commercial loans. Yeah, but after a period of time, after the acquisition of another company which was involved in this same sort of business but with a different model, wherein it used to collect the contractual cash flows instead of selling the commercial loans. What has the entity done? Entity has also changed its business model. So it has moved from sale to hold to collect contractual cash flows. Yeah, so this is a clear example of changes business model. Now, if the change in business model will happen, what will happen? Financial asset will have to be now reclassified on the basis of this model. Earlier, financial asset was classified on the basis of this model. Correct? Yeah. So now this has to change. Yeah. Let's look at another example. A financial services firm decides to shut down its retail mortgage business. That business no longer accepts new business, and the financial services firm is actively marketing its mortgage loan portfolio for sale. This is again what? This is again an example of change in business model. We have discussed about business models and their examples earlier also. This was just to sort of recap our understanding in terms of what is a business model and how it changes. Our focus today is not on the understanding of business model, because that is something we all know. Our focus today will be to understand that when this business model will change, how will the reclassification happen and how will the financial assets then be remeasured. Okay, yeah. Now, whenever there's a change in the business model like this, so what will happen? Initially, the financial asset, let's suppose, was measured at fair value through P&L. Now, the financial asset will have to be measured at amortized cost. Yeah. Now, in this situation, couple of options are available. And I'm not talking about the accounting standard, I'm saying a couple of options will come to our mind. And we may think, does it mean that financial asset will now be required to amortize cost? And we'll have to do this accounting from the beginning? Or an option is that financial asset should be measured at amortized cost starting from this date when the change in business model happens. So that means either we do retrospective or we do prospective. These are the two options available, correct? Yeah. Or these are the two things which will come to our mind. Now we need to understand that this change in a business model is not something which is in the nature of error. Yeah, this is a change which is based on the facts of the company. Because it's based on the facts of the company, there's a change which has happened now. That's why, what do? We do this accounting prospectively. So whatever we had done earlier, that was based on facts of the business. You can say facts and circumstances. And now when the change occurs, that is because of the changes in the facts. That's why this reclassification accounting will have to be done prospectively. We will not change the previous numbers. Those will continue to remain same. It's just that the numbers will have to be changed prospectively. Okay, yeah. So there's no retrospective application which will be required in this case. Okay, yeah. Now, before we move on to the reclassification accounting requirements, we can look at some of the examples, or you can say some more examples to just sort of brush up our memory by looking at some situations, some examples of what are not changes in the business models and wherein the reclassifications may not be required. So if you can just move further to this page number and to the situations following are not changes in the business model. So let's understand what are the changes which are not considered to be changes in the business model. A change in intention related to particular financial asset. If you go back to our discussion, we discussed that business model is all based on facts and circumstances, which has to be decided by the KMP, which has to be assessed for a business. But it's not something which is based on intent of the management. We cannot say that today the intent of the management is X and tomorrow it will change to Y. No. Business model will not be decided on the basis of intent, but on the basis of facts. So that's why if the intent of the management changes, can we say it's a change in the business model? No. Second, the temporary disappearance of a particular market for financial assets. Let's suppose certain financial assets are sold in a market, and that's the business model of the entity, only to sell. Let's suppose these were getting sold, but the market in which these assets were sold, that market is not available anymore for some time. Let's suppose we look at the scenario today. Because of Corona, the market has disappeared. Earlier, the buyers were available. When the entity used to sell these commercial loans, buyers used to be available. But now, because of the economic situation, which has turned around for some period of time, till the time this problem remains, the market for this type of business model has disappeared. But we say that this is only temporary? Can we say that because the market has disappeared, so that's why this business model will go off? No, that will continue to remain if that is temporary. Third, a transfer of financial assets between parts of the entity with different business models. Yeah. So if there is a transfer of financial assets between parts of the entities, parts means two parts of the entities, three parts of the entities, and those entities have different business models. And one part is maintaining model number 1, another part is following model number 2. Now, if some financial assets are moved from one part to another part, do we say it's the change in the business model? Not again. Okay, yeah. Then moving further, following changes in circumstances are not reclassifications. Let's see what are those changes in the circumstances which should not be considered to be reclassifications. An item that was previously a designated and effective hedging instrument in a cash flow hedge or net investment hedge no longer qualifies as such. Now, hedging is something that we'll discuss later on. And just quickly touch upon this point. What is a hedge? Hedge is when we cover our risk by entering into an instrument. Okay. For example, if we talk about forward contract, I'm sure you must be knowing about forward contract. So by entering into a forward contract, what is the entity trying to do? Entity is trying to cover its risk in relation to foreign currency. Okay, yeah. So that is called as hedging, wherein a hedging instrument is required, and there are certain accounting requirements, yeah, which require this hedging to be classified. Okay, or you can say hedging could be of some types. For the time being, that is what we can understand. Now, if an item was previously designated and effective, okay, and effective hedging instrument, so means there was an item which was hedging instrument, and the hedging was in the nature of cash flow hedge or net investment hedge. As I told you, there are types of hedges. So let's suppose if those are the hedges. So now this hedging instrument no longer remains as such. So now there's a change. Now that hedging instrument does not qualify as such. So should we say it's a change in the classification? No. An item becomes a designated and effective hedging instrument in a cash flow or a net investment hedge. Now let's suppose there's an item which becomes hedging instrument. Can we say that now it becomes hedging instrument in these two types of hedges? So that's why it should be called as a reclassification. Again, no. Changes in measurement for a financial instrument. If the entity takes credit derivative that is measured at fair value through P&L to manage the credit risk of all or part of such financial instrument, and consequently the financial instrument is also designated at fair value through P&L. Now this is something which you will understand in more detail when we discuss about derivatives. So you can just mark it, and when we discuss derivative you will just understand this point. So now what I'm doing is I'm now starting with examples, and with the help of these examples we will understand the reclassification measurement. Means when a particular financial asset will move from one bucket to another bucket, means will be reclassified, how should the accounting be done? Okay, yeah, that's what we are going to discuss now. And we can have multiple types of situations over there, depending on the bucketing of the financial asset. So before I get into that accounting requirement, let's understand which all situations are possible. A financial asset may be measured at amortized cost, which may now be reclassified to fair value through OCI, or which may now be reclassified to fair value through PL. So that means there are two situations, correct? Or a financial asset might have been classified as fair value through OCI, which may now be reclassified to amortized cost, or which may now be reclassified to fair value through PL. Possible? Yeah. Or a financial asset may have been classified at fair value through P&L, which will now be reclassified to amortized cost or fair value through OCI. Yeah. So these are the options which will come to our mind. Or that is how you need to understand that this is what we are going to discuss. Correct? Yeah. Okay, so we will look at case number 1. So we are now looking at a situation when the financial asset was measured at amortized cost and it will move to fair value through P&L. When an asset moves from amortized cost to fair value through P&L, how should that be measured? That should be measured at fair value, because if that will now be bucketed under fair value, it should be measured at fair value, correct? So what do we say? It is measured at fair value on the reclassification date. Any gain or loss arising from difference between previous amortized cost and the fair value will go to P&L. Now, fair value will not be equivalent to the amortized cost. That will be different, correct? Because the basis of measurement is different. So that's why if a financial asset was previously measured at amortized cost and now it is getting remeasured at fair value, so there will be a change. Let's suppose earlier it was 1,000 and now it is becoming 1,500. So where do we take this change to? P&L. Yeah. So let's look at this example now. Illustration number 24. So we have this small, all of these examples are small, but they will be helpful. Bonds for rupees 1 lakh reclassified as fair value through P&L. So bonds were earlier at amortized cost, and those have been reclassified to fair value through P&L. Yeah, earlier bonds were measured at 1 lakh, and now on reclassification their fair value comes out to 90,000. Correct? Yeah. Now in this case, what do? We will have to reclassify. For reclassification, we'll have to just pass the reclassification entry. So let's see what's the entry will pass. Bonds fair value through P&L debit. So now we are recognizing bonds once again, but bonds will remain bonds. So we are also de-recognizing the bonds. So what is the accounting entry will pass? Bonds debit to bonds. But how do we identify that what is getting recognized and what is getting de-recognized? By codifying that with the classification. So previously the bonds were measured at amortized cost. So we are saying de-recognize that. What was the amount? 1 lakh. So we will de-recognize at whatever amount they were appearing the books at. So this goes off. And what will get recognized? Bonds measured at fair value through P&L, wherein the valuation comes to 90,000. So that means there's a loss now. 10,000 is the loss. What do we call it as? Loss on reclassification. Debit 10,000. Okay. Simple and easy to understand. Yeah. Simple. I'm hoping that you're able to understand as to what we have been trying to do. We are just changing the classifications. And we are also checking that with the change in the classifications, where will the impact go? Okay. Next, fair value through OCI will be the reclassified category. So earlier it was amortized cost and now it becomes fair value through OCI. Okay. Now, under this new bucket also, the financial asset will have to be measured at fair value. Any gain or loss arising from the difference between previous amortized cost and the fair value will now be recognized in other comprehensive income. That's the difference. Now the difference, let's suppose earlier there was a difference of 10,000, which was taken to P&L. So this was taken to P&L. Now this difference will not go to P&L. Now this difference will go to OCI. Secondly, effective interest rate and measurement of expected credit losses are not adjusted as a result of reclassification. Now, expected credit loss we have not yet discussed. Yeah. So it may be completely new to you. You can just say, for the time being, what is this expected credit loss? It means if any provision is required to be created. Means, let's suppose this bond, which is a receivable, it's an asset, so it's a receivable. Let's suppose for some reason this is not collectible. So if its recovery is doubtful, what do you say? Create a provision for that. That creation of provision, which we understand in a normal course, is nothing but expected credit loss. Or you can say provision for expected credit loss for the time being. Yeah. So the standard says measurement of expected credit loss will not be changed. Let's suppose earlier any provision was created on this. So that will not change because of this reclassification. That will continue to remain. Correct? Secondly, it says when this asset was an amortized cost asset. Correct? So if this was an amortized cost asset, then definitely discounting must have done on this using effective interest rate. You remember effective interest rate? The discounting must have been done using effective interest rate. So the standard says on the reclassification, this effective interest rate and the measurement of provision, that means ECL, are not required to be adjusted. So those will not be changed. Okay. So let's look at one example for this. Illustration 25. And we are now on page number 12.93. Bonds for 1 lakh are reclassified to fair value through OCI 90,000. So what do we say? Now we will say it's fair value through OCI, debit, yeah, Now instead of P&L, we'll have to see what's the difference. Bonds at amortized cost, they will get derecognized, and 10,000, which is the loss on reclassification, where do we take it? This will now be taken to OCI. Clear? Yeah? Clear on this, all of you? So we have discussed a couple of situations wherein financial asset was initially, or you can say financial asset was appearing at amortized cost, and with the change in the business model, that moved to fair value through P&L or OCI. Now we'll look at next scenario wherein the financial asset was measured at fair value through P&L. Now we will say financial asset was measured at fair value through P&L. Okay. And now it goes to amortized cost. Now in this situation, it is measured at fair value on the reclassification date, and the fair valuation on it becomes the new gross carrying amount. Effective interest rate is computed based on this new gross carrying amount. Any gain or loss arising from the difference between previous amortized cost of the financial asset and the fair value is recognized in profit or loss. So let's understand. Now, when this financial asset will be moved to amortized cost, on that date, its fair valuation will be required to be done. Okay. And on that date, let's suppose its fair valuation comes out to 1 lakh. So this was appearing in the books at 80,000. On the date of reclassification, its value comes out to 1 lakh. So now this fair valuation will be considered to be the value at which this will appear in the books at amortized cost. Okay, so the new gross carrying amount at which this asset needs to start under this new model will be 1 lakh. Yeah, so that is how we will start the recognition of this reclassified amortized cost financial asset. Okay, on which we will then compute amortized cost accounting, or you can say we will then compute the impact due to effective interest rate. It's similar to the initial recognition of any financial asset at amortized cost. For example, let's go back to our discussion on the example of security deposit. You remember? We discussed that when a security deposit receivable is required to be measured, what do? On day one, we compute EIR. Yeah, we measure that at present value using EIR. Yes, that is what we do. So the standard says effective interest rate is computed on that new gross carrying amount. So this 1 lakh is on what? New gross carrying amount. Sorry, this is the new gross carrying amount on which we will now compute effective interest rate. Okay. And any difference which will arise between the previous amortized cost of the financial asset and the fair value will be recognized under P&L. Okay. So let's look at this illustration number 26. Bond for 1 lakh got reclassified to amortized cost. Fair value on reclassification is 90,000. So if the fair value on reclassification date is 90,000, so that will become the new gross carrying amount for amortized cost. So what is the accounting entry will pass? Now this will change and we have to check as to what will happen to this. Bonds will now be measured at amortized cost from fair value through P&L, and there will be now again similarly a loss of 10,000. Okay, yeah. Moving on to next situation. From fair value through P&L, now what's the other option available? It will go to fair value through OCI. It will go to fair value through OCI. Yeah. Now in this case, previously the financial asset was getting measured at fair value, and under fair value through OCI also this will be required to be measured at fair value. So in both the models, in both the classifications, the financial asset will be measured at fair value. Correct? The effective interest rate is determined on the basis of fair value at the reclassification date. Now the only change is that because it is fair value through OCI, because it is fair value through OCI, that's why a computation of effective interest rate would be required to be done. And when would this be required? When the asset will move to fair value through OCI. And therefore, the fair value on the date of reclassification will have to be considered once again, on which effective interest rate will have to be computed. Yeah. So let's look at one example now for this as well. Bonds for rupees 1 lakh got reclassified to fair value through OCI from fair value through P&L. And the fair value on the date of reclassification came out to be 90,000. And you may be thinking, so when it was 1 lakh earlier and getting measured at 1 lakh, and which was the fair value, then why we are saying fair value is not is changing now? Because this 1 lakh is for the financial asset which was measured at fair value, no doubt, but this fair valuation was not on the date of reclassification. We are saying on the date of reclassification, what is the fair value? This is 90,000. Even if the asset would have remained under fair value through P&L, its fair value on the date of reclassification was 90,000. Okay. Yeah. So now in this situation, what do we do? In this situation, again, same thing will have to be done. So we'll have to just change this. This is fair value through OCI. Yeah. And once again, there's a loss, correct, of 10,000. So by chance, we are just taking this example, which is having all of these numbers same. It doesn't mean that they will have to be same always. Yeah. It's just that one illustration has been picked up and that has been applied everywhere so that you can just understand the differences in the accounting by taking the same example over and over again. Okay. Moving further, now I think you all would know that we are left with only one bucket. What's that bucket? Fair value through OCI. So we'll have to now understand that part as well. Fair value through OCI. So let's suppose financial asset was measured at fair value through OCI earlier. Okay, that means before the change in business model, it was fair value through OCI. And now it changes to amortized cost. So what would happen in such a situation? Once again, we will apply the same thing which we did in case of fair value through P&L, changing to amortized cost. So what did we do? We computed the fair valuation on the date of reclassification. Yeah. So what do we do? Financial asset will be measured at fair value on the date of reclassification. However, cumulative gain or loss, which was previously recognized in OCI, is removed from equity and adjusted against fair value of financial asset at reclassification date. As a result, financial asset is measured at reclassification date as if it had always been measured at amortized cost. This adjustment affects OCI but does not affect profit and loss and therefore is not a reclassification adjustment. Effective interest rate and measurement of ECL are not adjusted as a result of this reclassification. I think this can be best understood with the help of an example. So that's why I'm straight away moving to example before getting into the explanation. And once we are done with the example, then I'll come back to this reclassification explanation. Okay, let's see what do we do. Bonds for 1 lakh got reclassified to amortized cost. Fair value on the reclassification date is 90,000. So this is the fair value on reclassification date. And 10,000 loss was recognized in OCI till the date of reclassification. Now you may be thinking, sir, what is this loss? What is this item? For this, you need to again go back to our discussion on classification of financial assets. In the case when this asset was categorized at fair value through OCI, what would have happened? Every reporting date, okay, let's forget this reclassification has happened. Forget that, huh? Let's suppose an asset was measured at fair value through OCI. Then what is the requirement? That at every reporting date, let's suppose this is the reporting date, this is the reporting date, reporting date, reporting date, reporting date. Reporting date means year end for our purposes. Let's suppose at every reporting date, this asset continued to remain at fair value through OCI. So what's the requirement? That we should compute the fair value of that financial asset. So let's suppose initially it was 95,000. Yeah, then it became 1 lakh. So there is an increase in the fair valuation. Yeah, there is an increase in the fair valuation by 5,000. Now, where do we take this change in the fair valuation? We take this change to OCI. So this goes to OCI. Correct? Let's suppose next year this changes to 90,000. Now there's a change of 10,000. There's a loss of 10,000. Where do we take it? Again, this change will go to OCI. This will go to OCI. This will also go to OCI. Correct? So this is how all of these changes in the fair valuations keep getting accumulated in OCI. Yeah. Now, let's suppose we have reached this date. Yeah. And on this date, what is the example saying? That the total amount which is accumulated in OCI because of measurement of the financial asset which was measured at fair value through OCI happens to be 10,000. So all in all, OCI has total accumulation of 10,000. Understood about this 10,000 now? Yeah? Clear on this 10,000? Okay. Other than this, it says this was appearing at 1 lakh and on the date of reclassification, its fair value came out to be 90,000. Okay. Now we need to check what will be the accounting entry, what will be the impact, or how will this be measured subsequently. Now, first of all, what do we need? First of all, the standard says that if there is accumulated gain or loss in OCI, that should be removed. Okay. And that should be adjusted against fair value of financial asset at reclassification date. Now, because it's a loss, so how do we remove it? How do we remove it? We will say to OCI, it's the reclassification loss, 10,000. And we are required to adjust it against the fair value of financial asset. So we will say financial asset. And what's the full name of financial asset? Bonds coded as fair value through OCI, debit, 10,000. So we have adjusted this loss against the bonds. Okay, so the loss is removed and taken to bonds. Yeah. What's the next step? Next step will be to recognize the bonds. Yeah. Or to reclassify the bonds from fair value through OCI to amortized cost. So how do we do that? How do we do that? So we'll say bonds debit. They will be debited at 1 lakh to bonds at fair value through OCI. Bonds amortized cost debit to bonds fair value through OCI. One lakh and 1 lakh. So we have de-recognized the bonds which were appearing at fair value through OCI, and we have recognized the bonds, at amortized cost now. Yeah. Now what we should do is we should come back to the explanation on case number 5. Yeah. On case number 5, let's come back to the explanation. So let's read out this once again. Financial asset is measured at fair value on reclassification date. However, cumulative gain or loss recognized in OCI is removed from equity, which is what we have done, and adjusted against fair value of financial asset at reclassification date. Yeah, and adjusted against fair value of financial asset at reclassification date. As a result, financial asset at the reclassification date is measured as if it had always been measured at amortized cost. This adjustment reflects OCI but does not affect P&L and therefore is not a reclassification adjustment. So now let's try to understand. So in this case, what have we done? In this case, because of this accounting, this financial asset has got measured in a way at the amount at which this would have been appearing if the amortized cost accounting would have been applied on this from the very beginning. And let's understand why. See, over the period, because of its classification under fair value, what has been the change? Change has been because of the changes in the fair valuation. That's it. Yeah. Or in simple terms, let's understand this way. Let's suppose initially, if instead of fair value through OCI, this asset would have been measured at amortized cost. Let's suppose instead of fair value, this asset would have been measured at amortized cost. Let's suppose that was X. Okay. Now this X should continue to remain X if this is under amortized cost, excluding the impact of effective interest rate. Okay. And I'm ignoring the impact of effective interest rate for some time. Now, because this asset did not go to fair amortized cost, instead it went to fair value. So what has happened over the period, over the years? This X kept changing. This would have increased or this would have decreased because of changes in the fair valuation. Correct. Now, if all of these changes in the fair valuations have been accumulated at one place and those have been adjusted back to the value of this asset, then what does it mean? It means that effectively we went back to the same value at which this should have been recorded at amortized cost, or you can say effectively the same value at which this asset would have been recognized at amortized cost. Yeah. So because of these adjustments which we have done, what has happened? Asset has got adjusted to its original value. Clear? Clear on this? Yeah. Any questions, any doubts in case you have, please let me know. Yes, any questions, any doubts? No? All right. So let's move further. So we now move on to the last reclassification. And what would be the last reclassification? All of you would know. You would say, now sir, the only option which is left is when the financial asset would be at fair value through OCI and it changes to fair value through P&L. That's correct. Then go to fair value through P&L. Okay. Now in this case, once again, what do we say? Financial asset was previously measured at fair value. Financial asset was previously measured at fair value, and under fair value through P&L also this would be required to be measured at fair value. The cumulative gain or loss which previously got recognized in OCI is reclassified to P&L as a reclassification adjustment at the reclassification date. Now, unlike what we do in case of reclassification from fair value through P&L to fair value through OCI, we will have to release the changes in the fair valuation over the period which got accumulated in OCI to P&L. Why? Because let's suppose if this asset was measured at fair value through P&L, then every reporting date changes in fair valuation would have occurred, and those changes in fair valuation would have gone to P&L. Correct? But now, because this asset was measured at fair value through OCI, that's why changes in fair valuation kept happening, but they didn't go to P&L. Instead, they went to OCI. So they got accumulated in OCI. So accumulation in OCI is nothing but going to equity. Correct? So now, on the date of reclassification, what do we need to do? We need to release that accumulated amount in OCI to P&L. So that means that should be taken to P&L. All right. Yeah. And once again, we have a small example to discuss this. Let's look at this example. This is page number 12.95. And I'm hoping that you are all following this study material right now. Yeah, so you all are with me. I have not been receiving any queries from you, and that's why hoping that you are all able to understand all of these points. It will be great if you can just confirm. I have not received any query, any questions from your side, which is very surprising. So I'm just hoping that you are with me. Huh? All of you are with me? Yes or no? You are all able to appreciate all of these concepts. Yes or no? The last message I received is from Anjali, yeah, when I think she joined. So great, I just saw this. Yeah, so you are all with me? Yeah? Okay, perfect. So let's move on to this illustration. Bonds for rupees 1 lakh reclassified at fair value through P&L. So those were appearing at 1 lakh and those got reclassified to fair value through P&L. Fair valuation on the reclassification date is 90,000. Pass the journal entry. So what do we do? Again, similar to what we have done in the previous reclassification adjustment. First of all, release the accumulation in OCI. OCI, loss on reclassification. OCI, loss on reclassification. 10,000. P&L, we will debit for loss on reclassification. And why we are doing this? This 10,000 is for the change in the fair valuation from 1 lakh to 90,000. Okay. And now, what has happened? Bonds will appear. Sorry, bonds at fair value through P&L will appear. Debit 90,000 to bonds fair value through OCI. Yeah, two bonds fair value through OCI 90,000. Okay, yeah. Clear on this, all of you? So with this, we are done in terms of our discussion on the reclassifications. And as I told you, that reclassifications are all required for financial assets only. It's a small topic, but you never know, anything may be picked up in the exam. So that's why on the financial instruments, you should be very, very careful. Fine. Yeah. Great. So now we can move on to the next topic. And Chavi has confirmed, yes, she's following all of these things. Very good. And I'm hoping the same for all of you. So now with this, we are done with our discussion on the reclassification. Now for the purposes of your revision, instead of just going through all of these examples, you can just look at a small summary. So that's why this presentation should really help you on that point. So let me just get onto this presentation quickly. Just 1 minute. This presentation captures all of these adjustments which we have just discussed in a summarized manner, and I'm hoping this should help you for the purposes of your revision. So all of these reclassifications, etc., that we have discussed, those have all been put down in the form of this summary, yeah, which you can just revise later on. But wherever you get stuck, please make a note of all of these small examples in the study material. You can just go through any of those examples to have a better understanding about any of these reclassifications. Okay, yeah. Clear on this reclassification? And this is something which is in continuation to the measurement summary. You remember this slide? This slide we discussed that this slide captures the measurement requirements under various categories, or measurement requirements for financial assets which are bucketed under various categories. Okay, yeah. I'm just hoping that both these things should be helpful to all of you. Ambika has a question. Ambika is saying, yes, sir, that means standard says in case of reclassification, all the adjustment regarding revaluation done earlier to the reclassification to be restated to give effect as the reclassification is done from the beginning. No, no. As I told you, it's not a restatement. Please understand. Because if you say it's a restatement, that means you are doing the adjustment retrospectively, which is not the case. Which is not the case at all. Please remember, we discussed that the reclassification impact has to be considered prospectively always, and that has not changed over here. So what has really changed, or what is really asking you to sort of come back to this conclusion? So that question which is coming to your mind every now and then is that, sir, we are doing a lot of adjustments from the previous year. So is that not a reclassification from the very beginning? No. And please understand that we did not do any adjustment from the previous years. It's just that since the previous years, a lot of amounts got accumulated and which were appearing on the date of reclassification. All of those amounts were appearing on the date of reclassification. We moved those balances. We moved those balances from OCI to P&L or from OCI to asset, whatever be the case. Okay, that doesn't mean we are doing retrospective accounting. So please be very, very clear, even though you may be getting onto the same conclusion in terms of numbers, but your understanding has to be very, very clear on that point. Yeah, Ambika, hoping you're clear on this. And so is the case for other students, all of you. Yeah, clear, all of you. Perfect. So with this, we are done with the reclassification. And now we'll start with a very interesting and considered to be a complex topic, derivatives. and embedded derivatives. And this is something that we have discussed many times and parked. In various examples, we talked about derivatives and we moved on. We didn't discuss about those derivatives in more detail. Now we need to get on to those derivatives. Okay, yeah. So what I'll do is I'll just quickly take you to some of those situations when we were discussing about derivatives or wherein derivative was referred, but we parked it. Yeah. So let us just go back to those discussions. Just give me 1 minute. Okay, so now I'm taking you back, yeah, to the old times. You remember the old times, the previous sessions that we had? You remember this slide? All of you will be saying, yes, sir, this is what we started with. And after that, we have covered a lot of sessions and now we are so thorough on all of these requirements, which is good. But as I told you that some part of the definition is not yet discussed, which will be discussed subsequently and which we did. But in all of those parts, every time there was a term derivative, we ignored it. We said that let's forget derivative for the time being. We'll talk about derivative later on. Okay. So I'm saying, where was this term referred to? When we started with financial liability, one part of the definition of the financial liability was this. And what does it say? It says, I'm just reading it out. A contract that will or may be settled in entities' own equity instruments. Now, what does it mean? We all know about it now, correct? Means when the entity will issue an instrument, but will not pay cash against it. Instead, entity will issue its own equity instruments for settlement. Remember, for convertible bond, cash was not paid. Equity shares were issued at the time of conversion. Yeah. And it says and means entity will do this settlement in this way, and that contract is a derivative. That contract is a derivative. Now, this is where we discussed. This is where this term was referred. And the contract is a derivative that will or may be settled other than by exchange of fixed amount of cash or another financial asset for a fixed number of entities on equity instruments. You must be saying, sir, all of these terms now we are able to relate. Yes, very good if you are able to do that. And that is only possible if you would have done a revision. Many of you might have not done the revision, which might not be able to appreciate this concept now. So I'll just quickly get onto this concept to help you understand this. A contract which used to get settled by fixed amount of cash, another financial asset, used to become what? Financial liability. Yeah. And wherein if the exchange used to be through entities' own equity instruments, then it was never considered to be a financial liability. Why? Because if the contract was settled by any means other than cash, other than financial liability, and what was that other than cash or financial asset? Equity. Then we used to call it as equity. We used to say that if the contract will be settled by issuing equity shares, then the contract will become equity instrument. Correct. But again, there was a catch. What was the catch? There was additional point which we used to discuss. And every time that point which we used to discuss happened to be the variability. Yeah, you remember? This is something which discussed quite a lot. We discussed that if the number of equity shares and their amount will be fixed, then it will be an equity instrument. Otherwise, it will become a financial liability. Correct? Yeah. Now, where did we discuss this point? Where did we discuss this point? So, I am now coming to this para to help you understand this. So in this para, we discuss this. This one. A contract which used to get settled in entities on equity instruments, and that contract was not a derivative, for which entity was obliged to deliver variable number of entities on equity instruments. So this used to become a financial liability. Correct? Now we are saying that contract will be settled through entities on equity instruments, and that contract will be a derivative, and that will be or may be settled other than by cash, other than by financial asset, for a fixed number of entities on equity instruments. Okay. Now you may be saying, but sir, in this case, fixed for fixed is there. In this case, fixed for fixed criteria is met. So should this not become equity? Let's think about it. In this case, should this not become an equity? Let's think about it. I'm reading it once again for you because this is very, very important. This all goes down to the reading of the para. Yeah, that's why I'm reading it over and over again. We are saying a contract will be settled by issuing own equity shares. Okay, and it's a derivative contract that will or may be settled other than by exchange of fixed amount of cash, other than by cash or financial asset for fixed number of entities on equity instruments. That means even if this criteria is met, but because the contract is a derivative contract, that's why it will become a financial liability. Then you may be thinking, so that's an addition to the definition of the financial liability. That's correct. That's an addition to the definition of the financial liability. Absolutely right. And that's why, what do we now need to understand? That, sir, under what situation a contract will be considered to be a derivative or a non-derivative. So for this, I'll tell you that all of the examples, all of the discussions that we have done so far, they have all been on contracts which were not derivative. Okay, so all the examples that we have discussed so far were not derivatives, all of them. But now we will start with examples, contracts which will be derivatives. Okay, so that means even over here we are not understanding the meaning of derivative. We are just referring to this term, and what I'm just trying to clarify is that this is where we skip derivative, and this is where, because the derivative was present, that's why an instrument was defined as a financial liability. Clear? Clear? Yeah. So now what gets left? Now the other thing that we now need to understand will be about the meaning of derivative. Okay? Yeah. So now let's move on to the meaning of derivative. Ambika has a question, sir. In this case, fixed for fixed not met. No, the fixed for fixed is given, but because it's a derivative contract, that's why it will become a financial liability. Now, I think the next question which you should try to focus on will be all about the understanding of derivative. Yeah. And once again, I would request all of you to get on to the study material, please. It's very, very important. Yeah. Because there are a lot of examples that we'll pick up from the study material itself. You can go down to study material, section number 5.2, page number 12.12. Sorry, page number 12.130. Okay, yeah. Can you please get on to this document quickly? Yes, you are on this page. Anjali is asking, sir, does it mean that all the derivatives are financial liabilities? See, once again, you will have to look at the perspective. From whose perspective you are looking at it? Should this become a financial asset or a financial liability? So, from the issuer's perspective, yes. Okay, yeah. And please go back to our discussion on financial assets. You remember the types of financial assets we discussed? Means the investment in debt instruments, investment in equity instruments. Therein also, I discussed one category, one type. What was that type? Investments in derivative instruments, or you can say investments in derivatives. So that means derivative can be go from both the sides, asset side as well as liability side. Clear? Yeah. You will get more clarity around it as we start discussing it and when we sort of complete this. Okay. This topic is considered to be a complex topic. That is what I understand. And that's why I need your attention, because you might have heard about this topic and you might have heard stories that, derivative is not easy to understand. It's very complex. So I would say yes, some of the terms of the derivatives are such which are not very easy to appreciate, but that doesn't make this to be a complex topic at all. Okay, so just do away with all of those fears if you are carrying in your mind, and it's not complex at all. So don't worry about it. And that is what we want to achieve now. But it's very important that you listen to all of these points carefully, because some of these terms are not so easy to read. And that's why we can best discuss this with the help of various examples. Okay, yeah. So let's move on to the derivatives. Let's try to understand first of all, what is a derivative? So any derivative will have these three conditions always. Yeah, any derivative will have all of these three conditions fulfilled always. So that means all the three criteria are mandatory. So the first one, You can just read this on the slide itself. Value changes in response to change in some underlying. You can say value of an instrument changes in response to change in some underlying. What is that underlying? It could be an interest rate, it could be commodity price, it could be foreign exchange rate, it could be various indices. For example, gold index, equity index, this could be various things. Okay. Now, if you can go to page number 12.130, we will try to understand this point about underlying. What do we mean by underlying? So if you can see a table, there's a type of contract which is called as interest rate swap. Let us understand about interest rate swap. What is interest rate swap? Interest rate swap means you enter into a contract with a banker. For example, I'm saying banker for example, and you take a loan. Okay, you take a loan. Loan carries interest at fixed rate. Okay, loan carries interest at fixed rate. And now, other than this loan contract, you have also done another contract with a banker. And what is that contract? Interest rate swap contract. Interest rate swap contract, which allows you to swap your interest rate from fixed to fluctuating, from fixed to floating. Yeah. So this is another contract that you have entered into. And why did you enter into this interest rate swap contract? Because you wanted to change your interest rate from fixed to floating whenever you want to do that. Okay. Now in this case, how will this swap work? This swap will work by changing the interest rate from fixed to floating. So that means what is that underlying which is getting changed? Interest rate. So if the type of contract is interest rate swap, what do we have as an underlying? Interest rate, which we say as underlying variable. Variable because it is varying, it is changing, or it can be changed. So that's why we are saying what is the underlying? Interest rate. That is underlying variable. Or in other words, we can also say it's the main price settlement variable. Yeah. Let's look at another example. Currency swap. Say for example, foreign exchange swap. Now when we have this contract for foreign exchange swap, what do we do? Foreign currency can be swapped. So what will be the underlying which will change? Foreign currency. Clear? Yeah. Similarly, there can be various types of contracts. Okay. I'll pick up some more. Let's suppose if we enter into a currency forward. Currency forward. What does it mean? Forward contract. Forward contract, you have heard about the forward contracts. I'm sure you must have dealt with forward contracts quite a lot. Even under Indian GAAP, there's a discussion on the forward contracts. So in a forward contract, what do we do? In a forward contract, today we enter into a contract with a bank that after some period, we will exchange the foreign currency with the bank at a specified price. That is a forward contract. Yes or no? Let's suppose today we have sold goods to a customer. for $100 and the USD is fluctuating. So we have a risk. What's the risk? The risk is that tomorrow when we collect 100 USD from the customer, then its equivalent INR value may go down significantly as compared to what it is today. That's a risk. Yes or no? That's a risk. To cover this risk, what do? I enter into a contract with the banker today itself when I made the sales, that later on when I will get the collection from my customer, I will exchange my $100 with you at a fixed price. So that means if I have sold goods of $100 and today let's suppose the dollar rate is 70 and I am expecting or I have a fear, I'm scared that this dollar rate may go down to 60. So if this goes down, what will happen? I will incur losses because equivalent INR value will go down and I need money in INR. So I enter into a contract with the bank that after 3 months, after 6 months, when I'll receive this, I will exchange my forex with you at rupees 65. And you may be thinking, sir, why 65? That is only an example I'm saying. So my fear was that after 3 months, after 6 months, dollar rate will be 60, but I've covered myself by entering into this contract and by getting a fixed amount against this USD. It may also happen that after 3 months, dollar picks up and the INR amount may get revised to may become 75 instead of 70 today, wherein it would have been a profit to me, but I will not get that profit. I will not get that increase in the value because my amount of USD in terms of its conversion to INR is fixed. So in this situation, what have I tried to do? I have sort of covered my risk. This is also called as hedging. Okay, I'm not discussing the hedge accounting with you, but this is a type of hedging. So now in this case, when we have a forward contract, then what's the underlying? The underlying is the foreign currency. Correct? Yeah. So the first thing that we discussed was that for a derivative, there has to be an underlying. Clear on this? What do we mean by underlying? Yeah. Okay. Next condition. There should be initial net investment which should either be nil or should be a very small amount. Which should either be nil or should be a very small amount as compared to what would have been an amount when this investment would have been done on a gross basis. And this is something again we'll get more clarity on with the help of an example. Okay, so that's why what we should do is we should straight away move on to illustration number 1 on page number 12.131. Because all of these things will be understood in the best manner by discussing examples. So let's get on to this illustration number 1. Entity S enters into rupees 100 crore notional amount, fixed year, 5-year pay fixed, receive variable interest rate swap with counterparty C. So entity S has entered into a contract with C. And what are the terms of the contract? Interest rate of the variable part of the swap is reset on a quarterly basis to 3 months Mumbai interbank offer rate, you can say MIBOR. So it's an interest rate swap. And what do we do in case of interest rate swap? The basis of the interest rate is changed. Yeah. So how will that change? Interest rate of the variable part of the swap is reset on a quarterly basis to 3 months Mumbai interbank offer rate. Number 1. Interest rate of the fixed part of the swap is 10% per annum. So there are two parts of the swap, variable part and fixed part. Entity S prepays its fixed obligation under the swap of rupees 50 crore. How do we get 50 crore? 100 crore into 10% into 5 years. Okay, because it's a 5 years contract, that's why what's the obligation? 100 crores into 10% into 5 years. So this is prepaid. Entity S has prepaid this obligation at inception, means at the time of entry into this contract. Discounted using market interest rates. This was discounted using market interest rates. Why was this discounted? Because this is for 5 years. So this is discounted, this is discounted. All of these are discounted. Okay. Entity S retains the right to receive interest payments on rupees 100 crores reset quarterly based on 3-month MIBOR over the life of the swap. Now we need to analyze this. Yeah. So let's analyze this. The initial net investment in the interest rate swap is significantly less than notional amount on which variable payments under the variable leg will be calculated. The contract requires an initial net investment that is smaller than would be required for other types of contracts that would be expected to have similar response to changes in market factors, such as a variable rate bond. So now the first thing that we have been analyzing in this case is about existence of a variable. Existence of an underlying. Now, do we have an underlying in this case? I think it's very clear to all of us. Yes. What is the underlying? Interest rate. That's the underlying. What's the next thing that we are checking in this case? That initially, when we are investing, so initially when we invest, is that a significant amount or nil amount or a very small amount as compared to what would have been done otherwise in relation to contracts that would be expected to have similar response to changes in market factors? Therein we understand that our initial investment is significantly lower. Yeah, our investment is significantly lower. Therefore, the contract fulfills the condition, no initial net investment or an initial net investment that is smaller than would be required for other types of contracts that would be expected to have similar responses to changes in market factors. Even though entity S has no future performance obligation, the ultimate settlement of the contract is at a future date. and the value of the contract changes in response to changes in the LIBOR index. Accordingly, the contract is regarded as a derivative contract. Now, before I conclude on this, and before you raise any query, let's understand the third part of the definition quickly. So the third part of the definition says that the contract will be settled at a future date. Now, what do we mean by settlement? Settlement means closed. And instead of this example of this interest rate swap, I will pick up the same example of forward contract, because that is something with which you are most familiar. In case of a forward contract, do we have an underlying? Yes, foreign currency is the underlying. Do we have significant initial investment? No. No. Correct? It's only a premium that you pay, which is a very small amount. Correct? Do you pay to the bank the entire money for the $100 at the time of entering into the contract? No. Yeah. Now the third situation is its settlement. Now the settlement can be gross or net. Let's understand what do we mean by gross or net. And this is something which is very commonly done in case of derivatives. See, derivatives you will generally find that are settled in net. And what do we mean by net settlement? In case of our example of forward contract, wherein the party went to the bank and entered into a forward contract for $100, let's suppose after 3 months. So after 3 months, what will happen? When the party will collect the dollars from the customer, so who will collect this amount? It's the bank who will collect this amount. Okay. And when the bank will collect this amount, so what will happen? Bank would settle this party, or you can say the final settlement between the party and the bank will happen on a net basis. So let's suppose if the bank collects the dollar from the customer, on which date the price of dollar happens to be rupees 60. On which date price of dollar happens to be rupees 60. So what will the bank do? Bank has incurred a loss, therefore, because bank would be required to pay 65. So this 5 is the difference per dollar. Yeah, this 5 is the difference per dollar. So this amount will be paid by the bank to the party. That's an agreement between both of them. Correct? This settlement, which we have discussed, is called as net settlement, because both the parties have settled for the increase or decrease. What is gross settlement? Gross settlement would mean that one party will pay full amount to another party, and the other party will also pay full amount to another party. But in case of forward contract, do we see any settlement through a full amount, gross amount? No. Or you can say not necessarily. Yeah, but it's very important that the contract is settled at a future date. So that's the third criteria that we need to remember in case of a derivative. Okay. Now coming back to this illustration number 1. In this case, this third criteria of settlement at a future date is going to happen. So that's why we are calling this to be a derivative instrument. What we can do is we can pick up another illustration, and with the help of that illustration, let's try to further understand this point of derivative. Entity S enters into rupees 100 crores notional amount, 5-year, pay variable, receive fixed interest rate swap with counterparty C. The variable leg of the swap is set or reset on a quarterly basis to 3-month MIBOR. The fixed interest rate payments under the swap are calculated at 10% of the swap's notional amount, that is rupees 10 crore per annum. Entity S prepays its obligation under the variable leg of the swap at the inception at the current market rates. Say the amount is rupees 36 crores. It retains the right to receive fixed interest payments of 10% on rupees 100 crore per year. Now, once again, we are required to analyze. And you will get more clarity once we analyze this particular scenario. And then we'll be able to compare both the scenarios. Okay. This contract results in an initial net investment of rupees 36 crore, which yields a cash inflow of rupees 10 crore every year for 5 years. By discharging the obligation to pay variable interest rate payments, entity S in effect provides a loan to counterparty C. That is what the arrangement is all about. Yes. Therefore, all else being equal, the initial investment in the contract should equal that of other financial instruments that consist of fixed annuities. Thus, initial net investment in this contract, okay, that means in this interest rate swap contract, is equal to the investment required in a non-derivative contract that has similar response to changes in market conditions. For this reason, instrument fails the condition no initial net investment or initial net investment that is smaller than would be required for other types of contracts. Okay. Therefore, this contract will not be considered to be a derivative contract. Now, in this case, we have used another term which has been called as non-derivative contract that has a similar response to changes in market conditions, for which you need to go to page number 12.131. 12.131 and look at a couple of examples. Some of the examples of this. What do we mean by this? Because as I told you, some of these terms may be complex, but they can be understood in a better manner with the help of examples. So let's understand. Examples of non-financial variables that are not specific to a party to a contract could be index of earthquake losses in a particular region and index of temperature in a particular city. Now, index of earthquake, index of temperature, are these financial variables? No, these have nothing to do with financial variables. These are considered to be non-financial variables. Okay, yeah. Now, let's look at some examples of non-financial variables which are specific to a party to a contract. So these were the examples of non-financial variables that are not specific to a party to a contract. Now, examples of non-financial variables which are specific to a party to a contract. Let's understand what are those. Occurrence or non-occurrence of a fire that damages or destroys an asset of a party to a contract. Yes. So if you talk about fire, can we say fire is a financial variable? No. But this will always be party specific. Can we say fire has done the destruction in general? No. This will be specific to a party. This can be discussed in the context of a party specifically. Unlike what we do in case of earthquake. because earthquake will not be specific to any party. Earthquake will be for a particular region wherein a lot of parties will get covered. And you may say, sir, fire can also have the similar impact. Fire can also cover a lot of parties, but fire can also be party specific, which is not the case for earthquake. We cannot say that only one building has, sort of experienced earthquake. Do we say that today there was an earthquake for a particular building? No, earthquake will always be for a particular region. But we can always say that today one building took fire. Yeah, got destructed because of fire. Yeah. Similarly, another example which you can see is the residual value of an asset which changes in response to changes in asset's physical condition, which is nothing but the depreciation. Yeah. But we are not talking about that depreciation financial variable. We are talking about that physical condition change because of which the residual value of an asset is changing. That is again what? Known financial variable, but specific to a party, to a contract. Okay, clear? Now, let's get back to that example. Illustration number 2. And I'll read out this point once again for you. Okay. The initial net, I'm on para number 2, on illustration number 2, on the solution, I'm on para number 2. It says the initial net investment in this contract, means in this interest rate swap contract, should equal that of other financial instruments that consist of fixed annuities. That's the outcome which we can understand. Thus, initial net investment in this contract is equal to investment required in a non-derivative contract that has a similar response to changes in market conditions. Okay. For this reason, the instrument fails the condition. No initial net investment or initial net investment that is smaller than what would be required for other types of contracts that would be expected to have similar response to changes in market factors. Now, this is the reason why we are considering this type of contract to be not a derivative. Okay, yeah. Yes, let's move on to illustration number 3 now. Let's move on to illustration number 3 on page number 12.133. Entity XYZ enters into a forward contract to purchase 1 million ordinary shares of entity T in 1 year. I think this is relatively simpler, so you should get some more clarity around the derivatives with this. Entity XYZ enters into a forward contract with entity T to purchase 1 million ordinary shares of entity T in 1 year. That in 1 year time, 1 million shares will be purchased. The current market price of T is rupees 50 per share. For T, it's rupees 50 per share. It's the current price today. Okay, and this is after 1 year. The 1 year forward price of T is rupees 55 per share. Forward price is rupees 55 per share. XYZ is required to prepay the forward contract at inception with rupees 50 million payment. Prepay with rupees 50 million Now let's try to analyze this. Okay. Purchase of 1 million shares for current market price is likely to have same response to changes in market factors as the contract mentioned above. Accordingly, the prepaid forward contract does not meet the initial net investment criteria of a derivative instrument. Now, in this case, we are trying to again analyze the condition of initial net investment. Now, the contract requires that XYZ should pay rupees 50 million. Okay. XYZ is saying that XYZ will buy the shares of T at rupees 55 after 1 year. It may happen that after 1 year, price of shares of T is rupees 75. Now, if this price is 75, what will happen? T will be benefited. It will be very, very beneficial for T because T will buy this at 55 and it's not an option to buy. It's a forward contract. It's a forward contract. Forward contract means it will have to be executed. Means both the parties will have to honor this. It's not an option contract. In case of an option contract, the party gets an option. So let's suppose in this case, if the contract would have been option contract, then T would have the option to buy it at buy after 1 year or not. But in this case, it's not the option. T will have to buy for sure. And it may also happen that after 1 year, the price of the share of T is rupees 45. If the price of share of T is rupees 45, then it's non-beneficial to XYZ. In fact, it will be a kind of loss to him. Because in the market, share is available at 45, but T would be required to pay 55 against this. Yeah. So something which is non-beneficial, what do we call it as? Out of money. Yeah. If you know about these terms, something which is non-beneficial, that is called as out of money. And something which is beneficial is called as in the money. In the money. In the money means beneficial. Out of money means non-beneficial. But we don't know about this because we don't have the information about future price. After 1 year, what is the price? That's not known to us. We are on today. Limited information is available in the question. So that's why we are unable to analyze that it's out of the money or in the money. But for the purposes of your understanding, it's important to know. Anyways, this will come later on in some of our examples. Now the question arises that today when T is entering into this contract, T will be required to pay rupees 50 million. Yeah. T will be required to pay rupees 50 million. And what's the market price of shares of T today? Rupees 50 per share. So effectively, T has ended up paying, today XYZ would be required to pay 50 million. Today XYZ would be required to pay 50 million. It's not T. And what's the market price of shares of T today? It's rupees 50. So that means XYZ is paying the full price equivalent to the market price today itself for entering into this contract. It's not a small investment. It's not a zero investment which XYZ has been doing. That's why can we say that this contract involves no initial investment, or initial investment which is smaller as compared to that contract that we have discussed? The answer is no. So that's why that condition of initial investment that is smaller or no initial investment would not be fulfilled in this case. You may have a question, but still there is a portion of rupees 5 per share. That means rupees 5 million, which has not been paid by XYZ and which will be paid after 1 year. That's true. But that is not what we see in case of a derivative. In case of a derivative, if you end up paying such a significant amount at the beginning itself, means on initial date, then that is not considered to be a derivative. Clear on this? Yeah? Clear on this? All of you? Yeah? Okay. Then the last part of this derivative is about settlement at a future date. However, as we discussed, this settlement is not necessarily required to be done gross or net. It's not relevant whether it's settled in gross or net. For example, again, I'm looking at this example from the study material itself. For example, an interest rate swap is a derivative instrument. Whether the counterparties pay interest to each other or settle it on a net basis. See, generally, how would the settlement happen? Generally, in case of derivatives, both the parties will not exchange full amount. For example, in this case, when these two parties are entering into the contract. Now, in this case, what has XYZ done? It has paid 50 million. It will then again pay rupees 5 million. And let's suppose on this date, market price becomes rupees 75. Then what should be the gain which XYZ should get from T? It should be rupees 20 per share. Generally, in case of derivatives, the benefit which one party gets from another party is only exchanged. So the other party will pay only the amount of benefit. So that means what will happen in this scenario? T would pay rupees 20 per share to XYZ. Because that is what XYZ has earned effectively in this contract. In this case, if this is at rupees 45, then XYZ would pay rupees 10 per share. This is called as net settlement. Generally, you will see derivatives are settled on a net basis. But at times, they also may be settled on a gross basis. But when we say gross basis, that doesn't mean that full amount should be paid at the beginning. Because if we pay the full amount at the beginning, the condition of initial net investment or no initial investment goes off. Okay? Yeah. Further, I'm just continuing on that example. Further, an option, say a call option. That means what is a call option? That is the right to purchase shares at a fixed price at a certain date in future. You remember we discussed that it's a forward contract, but it may happen that XYZ has an option that is called as option contract. Yeah, option means option contract. So there's a contract between XYZ and T which allows that if XYZ wants, XYZ can purchase shares of T after 1 year at rupees 55. That would become option contract. So we are saying further an option, say a call option, that is right to purchase at a fixed price at a certain date in future may expire unexercised. Why will that expire unexercised in this situation? Because if this is rupees 45 per share, will XYZ buy the shares of T after 1 year? No. Yeah, because it is out of the money. Such a contract will also be a derivative because expiry at maturity is also a form of settlement, even though there is no exchange of consideration eventually. Clear? Yeah. When such a right, such a contract will be there between XYZ and T, that will also be called as a derivative contract. Why? Because what's the underlying? Underlying is the shares. Do we have net initial, no initial investment? Yes. Let's suppose it's not so significant. In any case, in an option contract, you will not see this significant because that option is available to XYZ. Let's suppose XYZ has paid some small amount, say rupees, say rupees, what should be the amount? Let's suppose rupees 1 million. Let's suppose rupees 1 million for entering into this contract. That's a small amount. And when will this get settled? At a future date. But in this case, what do we need to understand? That settlement means the expiry of the contract. Even though two parties may not exchange the same thing, which is required. Why? Because one party has an option not to buy. So even then it will be considered to be a kind of settlement for our consideration of derivative. Okay, clear on this, all of you? Yeah. Any questions, any doubts? In case you have, you may just put down your query. Yeah, and what we can do is, I've just stressed this session quite a lot without a break. So we just take the break right away for 10 minutes. And after the break, we'll continue that discussion. In the meantime, if you have any query, please send that up. And after the break, I'll take up your query. And after the break, we'll also continue with this concept of derivative by picking up embedded derivatives. Okay, so we'll just continue. So embedded derivative is also something which will go in line with what we have discussed about derivatives. Okay, yeah. Hi, welcome back. So we can now continue with our discussion. Okay. And I have received a couple of queries before we move further. Chala is asking, sir, in this illustration, I think in some of the illustrations that we have discussed, could you please explain where is the concept of unrealized gain or loss? And if it's a gain in future, whether it will affect the conservatism, please explain. See, in this illustration, and when we are talking about fair valuation under Ind AS, there's no unrealized gain or loss. Please understand. And why do we say that? Because these are the instruments which are getting measured at fair value. So whenever they will be measured at fair value, the changes in fair valuation will take care of all of these unrealized gains or losses. Number one. Number two, when you say, sir, if it's a gain in future, whether it will affect the conservatism, I don't think so. And that is again something which you'll have to just sort of unfollow under Ind AS. See, Indian GAAP was more of based on the concept of conservatism, which is not there under Ind AS. Under Ind AS, as we have discussed earlier also, when we were talking about fair valuation, fair value measurements, the significant use is that of fair valuation under Ind AS as compared to historical cost, which used to be there under Indian GAAP. And that is why this concept of conservatism, you should just not think in the context of Ind AS always. Yeah. Next query is from Ambika. Ambika is saying, sir, is it the exercise price in case of an option which is equivalent to little initial net investment? No. See, what is the exercise price? Exercise price means the price that you will pay at future. That means that's the full price. So if you talk about that full price, that cannot be the little investment, or you can say nil investment, or say investment that will meet the criteria of a derivative. It's the small amount that you will be required to pay for entry into that contract. That is what we call as little initial investment. All right. Any more questions from your side on this? I'm hoping you are clear on this point. Okay, now moving further on to embedded derivative. You might have heard about embedded derivatives earlier, but I'm sure that you won't have gone into the details of embedded derivatives earlier. Now, if you are all clear on the meaning of derivative, and for which you can just consider some very simple examples of derivative, like any option contract, or say any forward contract. Sometimes some of these clauses which meet the criteria of a derivative may be present in any other contract. Any other contract means in a particular contract which is not really a derivative. Let's try to understand what do we mean. See, if we talk about interest rate swap, okay, now what is an interest rate swap? It's only about certain terms and conditions which have been agreed between two parties. That's why it became a derivative. So we are not saying that the contract has to be a documented contract, and because it has to be a separate contract only, then it will become a derivative. It's all about understanding between these two parties, which we have considered to be in the nature of a derivative. Now, it may happen that there is a contract which is not a derivative. For example, say there is a contract of a debt. means borrowings contract. Say you have taken a loan from a bank. Okay. Now, because you have taken a loan from a bank, that's why can we say that it's a derivative contract? Not really, because there's no underlying and there's no initial investment which is sort of nil or a very small amount. So there's no criteria of derivative which this contract will meet. So that means this is a non-derivative contract. But within this non-derivative contract, there could be certain clauses which may meet the criteria of a derivative. Yeah. And you may then think, sir, then why we are not calling this contract to be a derivative contract? That is because primarily this contract is not a derivative contract. Primarily the contract was a non-derivative contract. But there were certain clauses within this non-derivative contract itself which are in the nature of a derivative contract, or which are in the nature of a derivative, or which could be in the nature of a derivative. When some of those clauses are present in a non-derivative contract, we call that contract to be having embedded derivatives. Means derivatives are embedded in this. Derivatives are embedded in another contract. Yeah. Now, in such a situation, what do we do? When the derivatives are embedded in that contract, we need to analyze these two contracts separately. And the main contract, which we started saying as non-derivative contract, is technically termed as host contract. And the clauses within that host contract which meet the criteria of a derivative are called as embedded derivative. Okay. And on a combined basis, what do we say? On a combined basis, we will say that it's a hybrid instrument, which you can see on your screen right now. On a combined basis, we call it as a hybrid instrument. Yeah. For example, let's suppose there is a contract which is in the nature of a bond, and the bond is convertible bond. Okay. Now, in this case, what's the nature of the contract? Nature of the contract is that of a bond. But let's suppose there's a call option. And what's the call option? Call option means that the bonds can be converted into equity. It's not necessarily required to be converted into equity. There's an option available in this contract itself that after 5 years, the bonds may be converted into equity. Now, this option is what? This option is nothing but a derivative. Yeah. And can we say that this derivative is something which is similar to the host contract? No. What was the host contract? Host contract was one party is taking loan from another party in the form of a bond, and the legal form was a bond. So the nature of the contract instrument was borrowings. But along with this contract, these two parties also entered into another term wherein these parties said that one party will have the option to convert this loan into equity. Now, can we say that this option which has been given to one party or which has been agreed to by both the parties are similar to the nature of the contract or are in line with the host contract? Not necessarily. Not necessarily. And what is this arrangement called as, this arrangement needs to be analyzed, whether this can become a derivative or not. So yes, this becomes a derivative. And now because this becomes a derivative, and because this derivative is not a separate contract, but a part of the bonds contract itself, that's why we call it as embedded derivative. So what has been done? A derivative has been embedded into one contract. So that's why it's called as embedded derivative. Okay. So with this, what is it that I've been trying to explain you? That whenever we will talk about embedded derivative, so the accounting of embedded derivative will be similar to a derivative, because embedded derivative is also a derivative only. It's no different from a derivative. It's just that when a derivative is not a separate contract, but a part of another contract or is embedded in another contract, that is when the derivative becomes embedded derivative. Clear? Yeah? Okay. Now, because a derivative has been embedded into the host contract, I'm hoping that now you're familiar with these terms, embedded derivative and the host contract. Now, because we understand that there's an embedded derivative or there's a derivative which has been embedded into the host contract, standard requires that in some situations, we should separate out this derivative from the host contract and do the accounting separately. And in some situations, we should not separate out this derivative from the host contract, and the accounting should be done in a combined manner. Which means something like this should happen. Something like this should happen. So you can just look at the board. So we are saying this is within this host contract, there is an embedded derivative. Okay, yeah. So we are saying in some situations, standard requires what? This embedded derivative should be pulled out, should be separated. So we will have host contract and embedded derivative, which will then be accounted for separately if that is pulled out. And in case it's not separated, then what will happen? Accounting will be done for this combined contract, or you can say hybrid contract. Yeah. So this is, you can say, case A, and this is, you can say, case B. Now we need to understand that what will be the situation that will fall under this, or what will be the situation that will fall under this. Means in what situation we should separate out embedded derivative from the host contract, and in what situation we should not separate out embedded derivative from the host contract. Okay, clear on this? Because accordingly the accounting will vary. And in this scenario, please also remember one point, that you already know the accounting. Because when it comes to the host contract, do you know the accounting of host contract or not? So if there is a bond contract, have we discussed the accounting for a bond contract? Yes. You say, so many times we have discussed that. For a derivative, have we discussed the accounting? Yes. For derivative also we have discussed the accounting. You may have a question, but sir, for this combined contract, we have not discussed the accounting. Yes, I agree with you. For combined contract, we have not discussed the accounting. So for combined contract, we'll discuss as to what will be the accounting. But first step, which now needs to be understood, is about when should the separation be done and when should separation not be done. For which I would request all of you to get on to page number 12.134. On this page, a nice flowchart is available, which will help us to understand this separation criteria in a very simple manner. separation of embedded derivatives from host contract. Okay, I'm hoping you are all on this page. Yeah. Before this, I've got this query from Chala, so I'll just quickly answer the query from of Chala and then I'll get on to this flowchart. He's saying, for suppose if a company took a working capital loan from a bank in order to meet the liability in the form of interest on working capital loan. Company entered into a forward contract to buy the exchanges. Is this contract, can we say, embedded derivative or only a derivative? See, first of all, some of the terms you have used, I'm not able to understand, but what I could understand is that you are talking about two different contracts. One, taking a loan from a bank, and second, you're saying taking a forward contract. These two are separate contracts. So when you already have two contracts which are separate, so you'll account for them separately. You will not combine them. We are talking about a different situation. We are saying that within the working capital loan, for example, means when you enter into that document with the banker, within that document itself, within that contract itself, there are certain clauses which would meet the criteria for that. That is what we call as embedded derivative. Okay, clear? Yeah. So now moving on to this is section 5.2.2.1. 5.2.2.1. All right. In certain circumstances, an embedded derivative is required to be separated from the host contract and accounted for separately as a financial instrument. The flow chart below analyzes those circumstances. So let's go to the flow chart. First, does the hybrid contract contain a host that is an asset within the meaning of Ind AS 109? Asset means financial asset. So it says, first of all, we need to check that whether the host contract will become an asset or not. And I think it's very easy for us to do. We have discussed so many examples about financial assets. Okay. If we say yes, that host contract is an asset. So I'm going to the right side. If we say yes, then the standard says don't separate out embedded derivative. Means you need to look at it on a combined basis. In which case, what will you do? Entire hybrid instrument will be measured at fair value through P&L. And in this case, if you remember our discussion on the types of financial assets, today also we discussed that, three types which we consider: investments in debt instruments, investments in equity instruments, and investments in derivatives. So that was a financial asset which talked about investment in derivatives, and I told you that investment in derivatives is one type which will always fail SPPI. And that's why it will always be measured at fair value through P&L. Correct? Now the standard says that if you are accounting for, okay, I'm just forgetting about separation now. I'm saying separation is not done. Now let's suppose if you have any contract which has got features of derivative, which is clear, because in this contract we are not required to separate out embedded derivative. You may have a question, sir, why? Because that is what standard requires. That is what standard requires. Standard says if the host is an asset, don't separate out embedded derivative. In such a case, please think about it, that when the contract will have features of embedded, features of a derivative, can it ever meet the criteria of SPPI? No. SPPI will always fail. Yes or no? SPPI will always fail. That's why, how do we measure it? Fair value, and fair value through P&L. Yeah. Isn't it so simple if you try to correlate it with the same discussion that we had earlier instead of just learning it afresh? Yeah. Okay. And now I'm going on to the separate situation. Sorry, situation number 2. Does the hybrid contract contain a host contract which is not an asset? That means it's no. Whether it's an asset, so we say no. In that situation, standard says separate embedded derivatives that fulfill certain conditions as below. In such a case, standard says embedded derivatives should be separated out, provided some conditions as below are fulfilled. Let's understand what are those conditions. So separation is required provided those conditions are fulfilled. Otherwise, not. So that means every time we need to check whether those conditions are fulfilled or not. Economic characteristics and risks of embedded derivatives are closely related to economic characteristics and risks of the host contract. So what does it mean? It means that effectively, if you look at the embedded derivative, that is very much in line with the host contract. Its economic characteristics, the risks which are attached with it, are all similar to the host contract. So if those are all similar to the host contract, what's the benefit of separating it? Let's keep it combined. And if you keep it combined, what do? You will measure the hybrid instrument at fair value through P&L. If we say no, that means the economic characteristics and the risks which are attached to embedded derivative are not closely related to the host contract. Then what do? Then again we need to check one more point. A separate instrument with the same terms as the embedded derivative would meet the definition of a derivative. Means if we look at another instrument, yeah, which has terms similar to this embedded derivative of ours, or so-called embedded derivative of ours. That means now what are we checking? We are saying that will this clause or will the clauses meet the definition of a derivative? If we say no, that will not meet the definition of a derivative. So then what do? Do we need to separate it out? No. Then we don't need to separate it out. Then let's keep it combined. Yeah. If we say yes, a separate instrument with the same terms as embedded derivative would meet the definition of a derivative, then what do? Then we need to check, is the hybrid contract measured at fair value through P&L? If we say no, then in such a case, embedded derivative is separated and accounted for separately. Otherwise, what do? We keep it over here and do the accounting in a combined manner at fair value through P&L. Okay. Yeah. Now in this case, some of the things that we have discussed in this flow chart are now important for us to analyze. Let's understand those points. First point that we have discussed was about economic characteristics and risks, and wherein we check whether those are closely related to the host contract or not. You may have a question, sir, what do you mean by economic characteristics or risk? Means what do you mean when you say those are closely related to the host contract or not? For which I think we need to look at some examples. Let's get down. Let's get duo to 5.2.2.2. Okay, yeah, let's get on to this section. Some of the examples wherein economic characteristics and risks of the embedded derivatives may or may not be closely related to the host contract are now getting discussed. Okay, so let's look at all of these examples one by. So I'm on example number 1. Okay, I'm just clearing this part. Okay, let's look at example number 1. Yeah, this is illustration number 4 actually. So if you look at point number 1, sorry, this is illustration number 4. And this is page number 12.135. Yeah. Entity X issues a redeemable fixed interest rate debenture to entity Y. This is redeemable debenture fixed interest rate. Yeah, so that means entity X has issued debentures which are redeemable, carry fixed rate of interest. Amount of interest and the principal is indexed to value of equity instruments of entity X. So the interest, the principal and the interest, they are indexed to value of equity instruments of entity X. Now in this situation, I don't think I need to really talk about this point because this is something that we discussed in case of contractual cash flow characteristics tests also. This is something which we discussed in case of SPPI also. You remember? Yeah. When are the terms considered to be in line with the host contract? Let me just take you to that clause. Let me just take you to that clause. Let's go back to the discussion that we had. I'm just trying to correlate this because some of these things we discussed. I'll come back to this example after going through this point once again. You remember this point? Yeah, you remember these examples? We discussed that some of the instruments will qualify contractual cash flow characteristic test. They will pass SPPI and some will not. Why? Because there was no linkage in some situations of interest with the way interest is required to be computed as per SPPI criteria. Why? Because in certain cases, interest was linked with the equity. So in such a case, why did we say SPPI failed? Because the way interest should have been computed in a basic lending arrangement was not getting done. Yeah, you remember this? Now, same is the case we are discussing now. Now, please go back to the similar thoughts. That's why I require you to revise each and every time you need. Now, in this case, interest is required to be paid, but based on what? Equity of X. Principal is required to be paid, but based on what? Equity of X. Can we say that in a debt arrangement, this is how interest is required to be computed? Do you see this is how, do you see this interest computation in a basic lending arrangement? No. So that's why, what do we say in this case? In this case, host contract. What's the host contract? Redeemable debentures carrying interest rate at fixed amount is nothing but a debt instrument. Host is a debt instrument. Very clear. But the economic characteristics and the risks which you see in a borrowings contract are not closely related to these terms of the contract. That's why these terms of the contract, or you can say this term of the contract which require principal and interest to be computed like this, will be called as embedded derivative, and whose economic characteristics and risks will not be considered to be closely related to each other. Clear on this? Yeah. Clear on this? Yeah. So let's get on to the solution. Economic characteristics and risk of debt instrument are not closely related to that of the equity instrument. Hence, the exposure of this hybrid instrument to changes in value of equity instrument is an embedded derivative which is required to be separated. If you go by the flow chart, go to the flow chart. Now this is required to be therefore separated. The response above will not change even if interest payment and principal repayments are indexed to commodity indexed or similar underlying. When will this not change? Means when do we say that economic characteristics are not closely related? When instead of equity index, let's suppose we bring in commodity index. Therein again, you will say, but sir, all of these examples we have discussed. Yes, you are right. We have discussed all of these examples, and now you need to apply all of those examples over here also. Clear? Yeah. Can any of you give me one example wherein we can just say that this contract or this term will have economic characteristics similar to the host contract? Means by bringing in what term in relation to interest and principal, we can say that this embedded derivative will have economic characteristics similar to that of debt instrument. Yes. I'm hoping that you would be able to answer this. This is very, very simple. What is the term that you can add in this contract so that economic characteristics of this contract will become closely related to this contract? Yes, over to you. Quickly. Under what situation this will happen? I am waiting for a response. Quickly now. I am waiting for a response. You can just give me example of any clause by which for example, we are saying value of equity or equity index or commodity index is something which is not closely related. So what is it that will become closely related? Under what situation economic characteristics, risks can be considered to be closely related to the debt instrument? We have discussed this earlier multiple times, in fact. So let me just see who is able to recap that point and give me the answer. All of you, I'm waiting for a response. Quickly. Quickly, I'm waiting for a response. Who can answer this? Yes, all of you, please answer quickly. I'm waiting for a response. Huh? No response. Just try to think about it, huh? By having what term, economic characteristics and risks will become closely related. Anything that comes to your mind, even if it goes wrong, it doesn't matter. Huh? Just think about it and let me know. Quickly, just think about it and let me know. Chella has responded, very good. He's saying in case of equity instruments to meet the fixed to fixed criteria. All right. What about others? Try to answer this. Just try to think. Try to apply this concept. If it goes wrong, it doesn't matter, but it's important that you try to apply this. Yes, quickly. No more thoughts? All right. So let me just help you to understand this. And I think it's very, very simple. Let's suppose if we link the principal repayment and the interest computation with inflation index, then can we say that its economic characteristics will become closely related to the debt instrument? Yes or no? Tell me. And this is one example which we discussed also, which clearly shows that you are not revising the concepts. Yeah, can you see this example? Can you see this example? Did we discuss this or not? Yeah, did we discuss this or not? Yes or no? This can be a very simple example. In fact, all of these 4 points under this column, they are what? They are nothing but an example which you would have picked up. I showed you this slide also. Yeah. So once again, I would repeat the same point that it's very, very important that in case of financial instruments, you revise every time we meet. Yeah. Make sure that each and every concept you would have revised. Because can you now see there are so many concepts that we have discussed in the previous sessions and which are now getting used. And it's so easy for you to understand this point if you remember that. Otherwise, it's a sort of fresh learning for you. Yeah. And in the exam, you will need these linkages. Trust me, the questions may have certain points which may have interlinkage to various points. You will not be able to do that if you don't understand everything thoroughly and knowingly that most of the things under financial instruments are interlinked. Okay, yeah. So please keep this in mind. Very, very important. Okay, now moving further on to the next situation under this, and which is again a very, very common point which you get to see. See, whenever you take any loan from a bank, what is it that we are talking about? It's a borrowing contract. So when you take a loan from the bank, that becomes your borrowings. So in such a case, what will be the host contract? Borrowings contract. Yeah. In such a case, host contract will be the borrowings contract. And it is very common to see in a borrowing contract that there is a prepayment clause. Means a customer who takes a loan from a bank is generally allowed to prepay the loan. Let's suppose loan is taken for 10 years. There is always an option available for the customer to prepay the loan, say after 3 years, say after 5 years, or say after a certain fixed period. Yeah. Now we need to understand that this option which is available with the customer, which is nothing but a prepayment option, do we consider that to be a derivative or an embedded derivative? And how do we deal with this? Okay, let's understand. A call, put, or a prepayment option embedded in a host debt contract or host insurance contract is not closely related to the host contract unless options exercise price is approximately equal on each exercise date to the amortized cost of the host debt instrument or the carrying amount of the host insurance contract, or the exercise price of a prepayment option reimburses the lender for an amount up to the approximate present value of the lost interest for the remaining term of the host contract. Lost interest is the product of principal amount prepaid multiplied by interest rate differential. The interest rate differential is the excess of effective interest rate of the host contract over the effective interest rate the entity would receive at the prepayment date if it reinvested the principal amount prepaid in a similar contract for the remaining term of the host contract. The assessment of whether the call or the put option is closely related to the debt instrument is made before separating the equity element of a convertible debt instrument in accordance with Ind AS 32. Now, this entire para which I have read is something which is given in the standard Ind AS 109. Okay, and this was all technical literature which I have read. You may have understood some part of it and some part of it might not have been understood. Now, what do we need to understand out of it? We need to understand that this will meet the criteria or this will be considered to be closely related when the lender will get reimbursed for the loss he is going to incur. See, when the bank will enter into a loan contract with you for 10 years, so bank will expect that you will continue with this contract for 10 years. And this is how banks make money, correct? Now, when you are prepaying the loan, bank is losing out on interest, which they expected and for which they have made a lot of efforts. Yeah. So you must be receiving a lot of calls from the customer care. Sir, this is the loan. Do you want this more? Yeah. Every now and then we receive these calls. So after making so much efforts, they are able to sell a loan. And after the loan is sold, let's suppose if that gets repaid, they are losing out on interest. So what do we need to check? Are the banks getting paid for the loss at the time of that prepayment option or not? Means when that prepayment option is availed, will the banks be compensated for that or not? So that is one of the criteria for us to analyze whether the economic characteristics and the risks which are attached with this prepayment option will be closely related to the host contract or not. Yeah. Then we have an illustration with the help of which we can understand this in more detail, and there are also computations that will be required to be done again in line with the requirements of this Ind AS. But considering the time that we are now on to, I don't think we'll be able to complete this illustration. So that's why I'll not pick up this illustration. But yes, for sure, some of you who might have dealt with this earlier, some of you who might have read this earlier, yeah, and if you are getting some thoughts around whatever technical literature we have just sort of read now, I would suggest you to please go through this question or attempt some part of this question, whichever is possible on your part. Yeah, you may be saying, sir, but this part is not understood. No problem. Just try to go through this question once. Just try to attempt whatever part of this question you can do. Don't get into the computation. Just try to think about it. Just try to analyze that what will be the host contract, what will be the embedded derivative, and why it should be an embedded derivative. Okay, and what all situations could be there logically. Just think about it logically when this criteria can be met. Okay, yeah. So I would say that's the only homework for all of you today. Yeah, in terms of the discussion that we have had today. All right, yeah. So in the next session when we meet, we will start with this illustration, and it will be great if you would have solved this illustration, because then you can help me on solving this illustration also. All right, yeah. So now before we conclude our discussion for the day, I can come back to your queries, any questions that you may have. Yes, any questions, any doubts that you may have, please let me know. We can have a discussion on that before we conclude our discussion. Yes, quickly, all of you, any questions, any doubts in case you have, please let me know. See, tomorrow it's very, very important when we meet, you revise this topic that we have discussed today. It's very, very important. Embedded derivative, some part of it which I have tried to correlate with the definition of financial liability, some part of it which I have tried to correlate with that contractual cash flow characteristic test. Yeah, just revise this once. It will really help you. Otherwise, tomorrow you may forget many of these points. Just try to practice some of the questions independently without going through the solution. Even if we have solved that, just try to think about it. Why should this solution be really the one that we have discussed? That will help you to get a better grasp on the concept. And now, if you don't have any questions, then we can just conclude our discussion. Yeah. So we can just end our discussion now. All right. Okay. So thanks to all of you once again for your time and for your wonderful participation. Thanks so much.